Today, we're diving deep into one of the most powerful and most misunderstood wealth strategies here in Canada. That's the Smith maneuver. You probably heard people talking about it at the golf course, maybe in Facebook groups, or maybe from your mortgage broker. But most Canadians don't really understand how it works or how to safely use it to their advantage safely inside their corporations or in their businesses. I'm John Orr, the Chief Operating Officer and one of the co-hosts here at Canadian Wealth Secrets. We here at Canadian Wealth Secrets help Canadian business owners structure healthy wealth planning systems for liquidity and growth now, as well as a legacy that lasts. And by the end of this video, you're going to know exactly what the Smith maneuver is, how to implement it, and how it fits into a broader wealth strategy alongside tools like cash damming, life insurance leverage, and corporate planning. Most of us were raised to believe that debt is bad, that the only good debt is no debt. But that old school advice doesn't match the reality of how wealth is actually built. There is bad debt, like car loans, credit cards, which fund things that lose value. And there's good debt, debt used to buy appreciating or income-producing assets. The Smith maneuver is about using good debt strategically. It's about transforming your biggest liability, your mortgage, into a powerful wealth engine. And when done correctly, it converts non-deductible mortgage interest into tax-deductible investment interest. So instead of just paying the bank, you're building wealth, reducing taxes, and creating long-term financial freedom. Here's how the strategy works. Step 1, set up a readvanceable mortgage. That means every time you pay down your principal, your line of credit automatically increases by that same amount. Step 2, borrow from that line of credit, your HELOC, and invest those funds in income-generating assets. That could be dividend-paying stocks, ETFs, or even real estate like we've done here at Canadian Wealth Secrets. Because that borrowed money is used for investments, the interest on that loan becomes tax-deductible. Here's step 3. Repeat that process. Every time you make a mortgage payment, re-borrow and reinvest and claim that deduction. You're still paying your mortgage every month, but now those payments are doing double duty. They're paying down your home and they're building a portfolio that grows over time. Now, let's clear up a few big misunderstandings that cause some confusion. Misunderstanding number 1, the Smith maneuver helps you pay off your mortgage faster. Not exactly. Its main purpose isn't to pay off it sooner, it's to make it more tax efficient. Misunderstanding number 2, it's just borrowing from your home to invest. That's not the Smith maneuver. The key difference is that it's a structured, ongoing process. Each new principal payment gets readvanced and reinvested, creating a loop that builds your deductible debt base. Misunderstanding number 3, it's too risky. Risk comes from poor planning, not from the strategy itself. When done properly with good documentation and proper investment discipline, it's one of the most tax-efficient strategies available to Canadians, especially business owners. So the real danger isn't the strategy, it's actually poor execution. Let me give you an example from a listener that we had here on the podcast named Mandy. She had a $300,000 home equity line of credit linked to her mortgage. She wanted to invest $100,000 of that equity and thought that meant she was doing the Smith maneuver. But here's the key. She wasn't re-advancing her mortgage payments. She was just borrowing to invest. That's not the Smith maneuver. The true strategy involves using every dollar principal you pay down to re-borrow for investments. That's how you convert non-deductible debt into deductible debt. And here's the emotional part. Mandy felt guilty about having debt again, even though it was good debt. That emotional resistance is the biggest barrier most Canadians face. It's not math, it's mindset. We've been told that being mortgage-free means financial freedom, but that's not always true. For investors and business owners, real freedom comes from using debt efficiently, not avoiding it. Good debt works for you. It funds appreciating assets, it creates tax deductions, it compounds your wealth. Bad debt works against you. It funds things that lose value. The Smith maneuver flips the script. It turning your home mortgage into long-term investment tools. And once you see the debt as a tool, not a trap, that's when your financial mindset really changes. So what about, high interest rates? This is often a setback to people when all of a sudden rates start to change. Is the Smith maneuver still worth it? Absolutely. If it's structured properly. Let's say your HELOC rate is 7%. If you're in a 50% tax bracket, your effective borrowing cost after the tax deduction is only 3.5%. That's manageable, especially when your investments are compounding long term. Plus, inflation often drives asset growth, especially real estate. So over time, your investment growth can still outpace your borrowing costs. And if you're risk adverse, you can always use dollar cost averaging, investing gradually to smooth out that volatility. Remember, it's a long-term play. Think 10, 15, 20 years, not 10 months. Now, if you're a business owner, the Smith maneuver is just the start. There are other powerful strategies that work hand in hand with it. Number one is cash damming. This is for your self-employed professionals, your rental property owners, your real estate property owners. These are for sole proprietors. It lets you turn personal mortgage debt into tax-deductible business debt by flowing business income through your mortgage and then reborrowing for expenses. Number two is corporate-owned life insurance. This is the main strategy that we use here in Canadian Wealth Secrets. It's permanent life insurance, like whole life or universal life, and they can act as a corporate cash reservoir. We call this our wealth reservoir. It grows tax deferred. You can borrow against it for investments. That keeps that liquidity available for you. And when structured correctly, it can even pay out tax-free through your capital dividend account in your business. That's flexibility, that's liquidity, that's legacy planning done right. At the end of the day, the Smith maneuver, cash damming, life insurance leverage all share one mission: to make your money work harder than you do. These aren't risky schemes. They're proven structured ways to reduce taxes, increase cash flow, and build long-term wealth in Canada. If you want to see how these strategies could work for your specific situation, visit CanadianWealthSecrets.com/discovery, and you can book a free call with our team, and we can map out your personalized plan. If you also want to see where you are on our 4 stages of a healthy financial system, head on over to CanadianWealthSecrets.com/pathways, and you'll get a free report after filling out a quick assessment. Don't forget to like, subscribe, and share this with another Canadian business owner who's ready to build wealth smarter, not harder. I'm John Orr, and this has been another episode of Canadian Wealth Secrets.